A suspicious activity report, SAR, is an instrument used by banks and other financial institutions to report financial transactions that appear to be unusual or connected to criminal activity. SARs are provided for under the Bank Security Act (BSA) of 1970. In 1996, SARs became the standard form of monitoring suspicious activities and/or attempts to commit a crime like tax evasion, money laundering, insider trading. Financial institutions are responsible for submitting SARs. They do this using the BSA e-filing system. A bank's frontline staff may identify a suspicious transaction and report it to the personnel in charge of filing SARs. A financial institution must hold a SAR within 30 days of detecting a suspicious activity. In cases where the account holder's identity is unknown, the financial institution may use an additional 30 days to collect evidence to identify the person or entity, but must file the SAR within those 60 days. As part of its BSA compliance program, a bank is required to adopt a customer identification program or Know Your Customer (KYC). The institution does not have to prove that a crime has been committed when submitting a SAR. Staff members cannot notify an account holder that their account has been flagged for a SAR. This is known as tipping off. If a bank, through one of its staff, is found guilty of negligently or deliberately tipping off a customer when a SAR is flagged, the bank can face heavy penalties and sanctions. There are different ways in which banks identify a suspicious transaction. For example, an account holder may conduct a transaction they would not normally, or a transaction involving an unusually large amount of money. Alternatively, the bank may notice a sequence of transactions that appear to be done to hide another transaction. An account may also be flagged if it receives or sends money to another account that is already being monitored for suspicious activity. In the U.S., the body in charge of receiving SARs is the Financial Crimes Enforcement Network, FinCEN, an agency of the U.S. Department of the Treasury. The SAR must include who is conducting the suspicious activity, the instruments or mechanisms being used to conduct it, when the suspicious activity happened, where it happened, and why the institution thinks it is suspicious. The SAR is essential for many reasons, which is why almost every country has a version of the report as part of its anti-money laundering efforts. SARs often initiate serious investigations, sometimes revealing crimes like money laundering and terrorist financing. SARs also protect the financial institution's integrity and prevent them from spending money on fines for failure to timely file a SAR. Are SARs effective in curbing the flow of tainted funds through financial institutions? Or will financial institutions need to evolve their accounting monitoring tactics with the growing popularity of digital assets? Stay tuned to find out. Cheers!